housing affordability in China is among the worst in the world. It would take more than 50 years of median household income in Beijing to buy an average apartment.
Real estate, because for decades, a strong housing market propelled China's economy forward, and it lifted millions of people out of poverty.
China's property market is in crisis. Real estate prices that have skyrocketed over the past few decades have now begun to fall back to earth. Now the question is, will collapsing home prices also bring the world's second largest economy down along with them? Will the real estate crisis in China hit the global economy? Let's take a dig. China's strong economic growth, one of the most rapid and long-lasting for a major economy in history, was driven for many years by a housing boom brought on by urbanization and population increase. However, the crucial real estate sector, which has historically contributed up to 30% of the GDP, entered a crisis over 2 years ago as a result of a government-led crackdown on developer indebtedness. The world, which has come to depend on China as a dependable engine of prosperity, is being shaken by tremors in the country's real estate sector. Large developers are collapsing due to massive losses, overwhelming debt, and late lender payments. A protracted construction boom that drove China's economic expansion has stopped, endangering millions of people's savings and jobs. China's currency has depreciated and its markets have plummeted as the country's authorities seek to promote growth. What's going on with real estate and China's economy? China's economy was predicated for many years on a thriving real estate market driven by population expansion. China's expanding middle class was able to store cash and create jobs thanks to the housing sector. Land sales money was a source of income for local governments. However, the population of the nation isn't increasing as it once did, and years of severe COVID-19 restrictions have unnerved Chinese shoppers. Along with the government's crackdown on dangerous practices in the sector, real estate developers now face massive debt and a shortage of new homes relative to demand. Home values have plummeted, undermining the confidence and savings of Chinese consumers as the government attempts to shift the economy from one driven by exports and state-directed investments to one driven by domestic consumer spending. A common business strategy used by many Chinese developers for many years was to sell flats before they were built. After adopting market-oriented reforms, the nation had a rapid era of urbanization, prompting regulators to create the model in 1994 to satisfy the surge in demand. Real estate tycoons were some of the wealthiest persons in the nation as a result of their rapid growth, which was financed by the proceeds from sales. Up until around 3 years ago, when the Chinese government clamped down on the real estate industry's excessive borrowing due to concerns about the possibility of financial instability, the plan essentially succeeded. Additionally, it aimed to reduce the hazards brought on by skyrocketing debt as well as rising real estate values. Developers like Evergrande, which ultimately failed to pay its debt holders in December 2021, suffered a greater financial problem as a result of the decision. How severe is it? Unpaid debt from private Chinese developers is estimated to be worth $390 billion by Gavical Research, which poses a serious risk to the economy. Many economists have revised their estimates for Chinese economic growth, bringing many of them below the government's 5% target. Recent months have seen a decline in both imports and exports, as foreign investment in the nation fell by more than 80% in the second quarter of this year compared to the same period last year. For the first time in 2 years, consumer prices in China decreased in July, suggesting that Chinese households were cutting down on their spending. The Hong Kong stock market's Hang Seng Index recently experienced a bear market, plunging more than 20% from its peak in January. What companies are at the center of this crisis? The biggest real estate developer in China, Country Garden, stated recently that it anticipates reporting a loss of up to $7.6 billion in the first half of the current year. Investors fear that the corporation would fail on billion-dollar loans, which has caused the share price of the company to plummet. Another significant real estate developer, China Evergrande, recently declared bankruptcy in the US while reconstructing its debt. In 2021, the company's $300 billion debt default was one of the first significant indicators that the Chinese real estate market was in jeopardy. Financial trust businesses in China, which provide investments with better returns than regular bank deposits and frequently engage in real estate projects, are also feeling the effect of the sector's problems. Recently, Zhongrong's International Trust, which oversees assets valued at approximately $8 to $5 billion, failed to make payments to investors. Social media videos surfaced of a group of investors demanding repayment from the corporation as they demonstrated outside its Beijing offices. How is the Chinese government handling all of this? 2020 saw the beginning of China's crackdown on careless borrowing, which compelled businesses to pay down existing debt before taking on new debt. This resulted in issues for developers with high debt levels, such as Evergrande and Country Garden. Standard & Poor's reports that over 50 Chinese real estate developers have not paid their bills over the last 3 years. The administration recently unveiled plans to boost investment and spending, but the specifics have not been made clear. The majority of corporate loans are made on a 1-year loan rate, which China's central bank lowered on Monday. The 5-year loan rate, which is used to determine mortgage prices, remained the same. Analysts had anticipated more assertive actions. Analysts and specialists are highlighting underlying problems that may have significant ramifications as China struggles with an increasingly severe economic crisis. According to experts, the crisis's effects go beyond the economy and affects households, consumer confidence, and attitudes among foreign investors. The real estate crisis is serious, according to strategic affairs specialist Brahma Chelani, and it presents a big obstacle for President Xi Jinping's leadership. As China grapples with a deepening economic crisis, analysts and experts are pointing to underlying issues that could have far-reaching implications. Experts believe the ramifications of the crisis extend beyond the economic sector, impacting households, consumer confidence, and international investor sentiment. Brahma Chelani, a strategic affairs expert, highlighted the severity of the real estate crisis and suggested that it poses a significant challenge to President Xi Jinping's leadership. China's real estate crisis is actually a bigger crisis confronting Chinese President Xi Jinping. China's president is in a hurry, feels like he has a small window to put China back on track, Chelani said. He added that the need to revive China's economy urgently might encourage risk-taking and even result in crackdowns on demonstrations. What effect could China's troubles have on the global economy? According to Chelani, structural issues, including an aging population and rising debt, are exacerbating the problems, and the Chinese real estate recession is a component of a wider economic crisis. These long-term obstacles might make it more difficult for China to realize its goal of becoming a worldwide environmental superpower. China is the world's factory floor. The crisis in China will hurt global eco. It will be very difficult for China to come out of the crisis given long-term constraints, he said. Zhongluang Zoiliu, a fellow for the China Studies on the Council of Foreign Relations, emphasized the concerns of foreign investors, particularly regarding the contagion effects stemming from the real estate sector's financing practices and the state of China's shadow banking system. The trust industry, valued at $2.9 trillion, has attracted regulatory attention as authorities seek to manage potential risks. A lot of the contagion concerns come from how the real estate sector has been financed, trust industry. A lot of the contagion concerns come from the state of China's shadow banking system. China's property market is the face of a deeper crisis that has ripple effects across sectors' households. The crisis will, deeper down, hit Chinese consumers and international investors' confidence in China, Liu said. According to BCA research, China has contributed more than 40% of the growth in global economic growth over the last 10 years, compared to 22% from the US and 9% from the EU. Businesses that conduct business in China, such as American technology corporations and European luxury goods groups, suffered from a decrease in consumer expenditure in that country. A faltering Chinese economy also translates into a decreased demand for minerals, oil, and other industrial building blocks. China is one of the biggest trading partners of the United States, spending billions of dollars on American machinery and agricultural products. Nevertheless, thus far the response from international investors has been somewhat subdued. Despite a 3-week run of losses recently due to signs of trouble in China's economy, the S&P 500 is still up for the year thanks to large technology companies. Due to persistent inflation, investors in the US and Europe have also been preoccupied with the national central bank's upcoming interest rate decisions. That's all for now. Thanks for watching. If you enjoyed this video and found it useful, don't forget to hit that like button below. And if you want to stay updated with more great content like this, make sure to subscribe to our channel by clicking the red button and ringing the notification bell so you never miss any future content from us. Your support means the world to us. Thank you and goodbye.